It is a sunny and warm Thursday afternoon, Thursday, August the 13th, and welcome to the Portfolio Stewards Huddle. Thank you very much for taking time from your busy schedule to join us today for the live webinar, or even if you are listening in to the recording. I am Bob Simpson, your host for this series of webinars. I'm joined today by regular participant, Paul Tyers, Managing Director at Portfolio Stewards. Now, just a little housekeeping. These sessions are recorded and you can find them if you go to portfoliostewards.ca, or if you want to register for an upcoming event, just go there and you'll see the regular webinars to keep you informed. Also, we encourage you to ask questions during these sessions, and we'll be watching for such questions. So, please, if you have a thought, if you have a comment, if you have a question, please go to the control panel and go to your control panel, click the Q&A, type in your question, and we'll be glad to answer it and address your question directly. So number one, let's talk about this. I call this your guide through the storm rebranded. Since March 13th, we have presented and recorded 13 sessions to keep you updated during a very difficult period for investors in financial market, as financial markets have reacted and recovered from COVID-19. Now, during this period, your Portfolio Stewards Investment Management Committee has been hard at work analyzing and adjusting portfolios to take advantage of the opportunities and to protect you from the risks that were involved during that period. Today, we're launching a rebranded version of your Guide to the Storm, and we'll continue on this probably monthly. We're still playing around with the frequency, but we're currently thinking sometime in mid-September will be the next session. So welcome to the Huddle. Now, what is the Huddle? The Huddle is a webinar series designed to, number one, keep you up to date with what is happening in financial markets, to introduce you to the opinions of some world-class investment managers. Similar to what we've done in your Guide to the Storm, we will constantly be bringing portfolio managers on the call just to get their views. We believe that it's important not just to form your own views, but to listen to some world-class managers. We also want to keep you aware of changes that are taking place in the portfolio, and we want to share ideas to help you to stay informed, largely without the hype of the financial media. That's one thing that I suggest to people all the time. If you want to improve your investment portfolio performance, stop listening to the media every day, because they are there to sensation the data and the information to sell advertising. So in today's session, we're going to take a look back at the storm, COVID-19. It has and continues to affect financial markets. We're going to discuss the changes that have taken place in the portfolios, and we're going to explain why. So number one, just to look at financial markets again, you can see the sharp decline, the S&P 500 declining over 30% as the news of COVID-19 hit the markets. And it has recovered and is now slightly in positive territory, whereas the TSX had a 33% decline, largely because energy prices took a major hit during that March period, and it has recovered most of the losses that were incurred on a year-to-date basis. Now, when you look at portfolios, you see, we call it front stage and backstage, that in most cases, your portfolio is a split between equities and fixed income, or as we manage portfolios, fixed income and or some private debt that we've been using to improve returns. But that's what you see on the front side. Now on the back side of the, behind the curtain, we look at it that there are four different components. There's the fixed income or private debt component. there's individual securities. There are managed investments where we use mutual funds or ETFs to access parts of the market that we do not feel that we have the expertise to run, but we believe there's an opportunity in, and real estate as well. Now, managed individually, each of these are managed individually to generate the best return. So it's not like we're looking at an overall portfolio. We're looking at each of these 4 components, and we're trying to generate the best possible return, risk-adjusted return for each one. Then when we combine that by having that individual focus and then combining those strategies, we believe that is a much better way than trying to manage a portfolio sort of from a top-down. We take a bottom-up approach to it. Now, during the storm, we analyzed each of these components. First, we looked back at how we looked back at how each investment in the portfolio performed during positive periods, and then we also took a look at how they performed during the storm. Now, just to throw an analogy at you, being a portfolio manager is similar to running a sports franchise, to being a general manager of a sports franchise. So, to use Kyle Dubas of the Leafs as an example, we want to put the best team on the ice that gives us the best chance of winning a championship. But we also want to avoid being a one-season wonder, where we have one great season, but followed by a series of bad seasons that follow. So we prefer to have a team that competes for the championship every year. We know we may not be number 1 every year, but we want to compete. We want to be one of the best performers within the marketplace. We want to build our team from the net out. And that's a theory that general managers follow in hockey. We want to build a strong defense first to take the pressure off the offense. So we need strong goaltenders, we need good defensemen, and we need good forwards who are going to back check and help to protect our net. We need also to constantly assess all of the players on our team to identify which ones are getting the job done and where we need to look for replacements. We also think that we can never be satisfied with the team that we have, because as soon as we stop getting better, we start getting worse. So it is our job as portfolio managers to constantly review and constantly try to get better, so that we can compete year after year for that championship. And we also have to play it one game at a time, the old standard line of a hockey player when he's doing an interview. We need to take it one game at a time, one day at a time, because the circumstances change. So we have to be ready to change to stay competitive. So there's my analogy for the day for you. Now, when we looked at our performance over the past few months, especially through the storm, and we look at the private debt and fixed income area, and this is our rating of our own performance, and we rate that we performed in that area as an A-. There were still some areas that we can improve, but we thought that we performed very well, and I'll show you why we believe that. But there were some disappointments, and here's an example of one of the disappointments. Pender corporate bond that we owned. When we are investing in bonds, we're looking for stability. We're looking for consistency and stability. We don't want declines like we experienced with this, where the investment, which is a bond investment, declined over 15%. Now it's recovered most of that decline, and we held in through that whole period for, up until, we were just slightly negative before we made an adjustment there. Now let's look at some of the other components of the portfolio. Cortland Credit returned over the last year. You can see the orange line. That's Cortland Credit's performance. It returned 6.06 without any real dips in performance. And we compare that to the Canadian Bond Index. which had a pretty significant decline. And this is going back to 2016. So we're looking in the bond area for consistent and predictable performance, and Cortland delivered on that. Trez Capital returned over the last year 7.83%, exactly in the range that we were looking for. Again, straight line performance. Quest, 7.48, straight line performance. The CIP Stewardship, the SAFE Fund, performed a little bit negatively, and maybe I'm just going to ask Paul to just comment on SAFE for a sec. Paul, you're on mute.
Thank you, Bob. The reason why I wanted to just explore this a little bit further is because there are a lot of individual investments in here that are being held at their original book value. So I'll give you an example, one example that I hope will make it clear. We have a few investments in the development of Alzheimer and dementia homes. And we went into that with the idea that we would go through the development period and lease up period, and then they would be sold to typically a pension fund or an insurance company. During that period of time, we do not adjust, even though we might be 6 stories high and or ready to lease, we do not adjust the market value of that security until we know what the sale price is. And so, in fact, in there will be some embedded profitability that hasn't yet manifested itself in this return. So we've got a few investments, significant ones, in the Stewardship Alternative Income Fund like that. And they typically have a range of sort of 3 to 4 years before they manifest themselves and show true market value. So it's not quite an accurate thing, but we still are targeting in there about 7% return, very similar in line with the other alternative private debt options.
Yeah, so Paul, I'm kind of excited right now because we actually have our first question of the day. And the question is, so as I look at this slide on fixed income and private debt, you have Cortland and Quest, for example, that seem to be doing really well in getting us good returns. Why do we bother having equities in the portfolio at all? You want to address that?
Well, it's a great question. And increasingly, I mean, I think if we look at expected rates of return for Canadian equities and then US equities, we would put over a 10-year period of time about an 8% rate of return for Canadian equities and about an 8.5% to 9% for US equities. And so looking at this, there isn't a meaningful amount of difference. However, over the long run, we do believe that there are some of the equities, and particularly as we get more focused, that will provide, that will make it worthwhile to have some equities. I think the other element is very commonly fixed income is the most highly taxed. And so if we earn a 6% rate of return and it's taxed as income, and it's outside of an RSP or other registered plan, you're going to pay about 50% of that back to the government in taxes. Whereas with the equity, we only pay tax on dividends received or when we actually sell it. So those two elements are the primary reasons why we still have equities in portfolios.
Mm-hmm. Okay, so moving on. As we've looked for replacements for investments like the Pender Bond Fund, we've chosen a couple, one being the CI Merit Alternative Absolute Return Bond. And you can see there there's the dip, a small dip from, call it up 3% to down to up 2% during the storm, but really consistent and predictable returns. We've also added Antrim, and Antrim, if you go and watch the guide through the storm session, the last one, session 13, we interviewed the manager of Antrim. Their 1-year returns 7.2. They expect in the 6.7% range over the next 12 months. But again, good straight line returns. So, based on all of that, we would say that, performance of this part of the portfolio has been very good.
Bob, can I just, in the interest of clarity, I wonder if you would just go back a couple of slides to where we actually had the Pender Bond Fund.
Mm-hmm.
And I think I just want to reinforce the fact that here's an example of something that had an unexpected decline. Thankfully, it did come back. But today, we're looking in the future and saying, how do we make sure that we avoid that unexpected event going forward? And that's where, when you look at both the Merit Absolute Return Fund and the Antrim Fund, we're looking for as smooth a ride as possible. Even if you end up at the same spot, we would much rather end up with a smooth ride than the volatility that took us by surprise, and quite frankly, it took the bond manager at Pender, whom we've spoken with, by surprise as well. We just can't afford that going forward.
Okay, so we're going to move on next to our managed equity investments. We're going to rate performance in that area as a C-. So not a score that we like. We prefer to score much higher than that. But looking back at that, and maybe Paul, you can just talk a bit about the relationship that you had with Dimensional Fund Advisors and their approach and kind of what you saw when you allocated funds to DFA over the last few years.
Absolutely, Bob. Dimensional Fund Advisors is historically one of the preeminent managers in the world. And they have won so many accolades for this historically over the last 30 years. And with this academic research that pointed out that by going with value stocks over growth stocks and smaller companies over larger companies, well, not exclusively one, but tilting towards value, tilting towards smaller cap, actually had outperformed growth securities and large cap names that we might know. That research manifested itself in actual results through to about 4 years ago. And at that point in time, some of the tech giants in particular started, which were clearly growth stocks and not value stocks, they really started to take off. And coincident with that was really where large companies started to take on better return than some of the historical track record of smaller companies. And really, after observing this, having several meetings along the way with Dimensional Fund Advisors, both from their US team and their Canadian team, we concluded that we could not wait for this to manifest itself any longer. And really the catalyst for us was COVID, and saying that we need to get a lot more focused on securities, equities in particular, where we knew the sector that company operated in, and we knew what we felt we had a better handle on the prospects of the individual companies. So this was a fairly significant change, and I think given the circumstances is the right change, given the circumstances we find ourselves in with COVID.
Okay, thanks, Paul. Now, you can also see that through this presentation that we take, going back to the sports analogy, that we're taking much more of a Moneyball quantitative analysis approach towards things now, that we have capabilities that most other advisors do not have. So we can go in and rank, and so I rank DFA International against all other Canadian-based international funds. and over the last 3 years to give them, enough sort of runway for performance. And they turned in a 3-year annualized return of only 2.16%. So that's 2% a year for the last 3 years. And that ranked them number 59 out of 83 Canadian-based international funds. And that just doesn't make the cut for us. So based on that, we just couldn't give them any more runway, decided it was time to make a move. Now, we also have a position in DFA, the US Core Fund. It ranked sort of in the middle of the pack, 114 out of 197, but it returned 10.25% annualized over the last 3 years. So, around the 30 to 33% total return over 3 years, which is quite acceptable. So it continued to make the cut. And, I talk about the Pender Opportunities Fund that's there. We have a meeting coming up with them, I think on Monday, Paul, right?
Yes, next Monday, yes.
And we just want to, we want to re-look at that investment to ensure that it should continue to be part of that strategy. The one area that really was disappointing, and it's really not so much the manager, but more the market, is real estate investments. So, we all hear stories that housing prices in Toronto haven't really dropped. They've held pretty steady in 2020, even with COVID-19. But the publicly traded real estate investment trusts have performed poorly. We did have the manager from the CI Signature Fund on the line with us. If you want to go back and hear her comments about what's going on in that space. So one of the recordings on your Guide Through the Storm, Kate McDonald, and she gave us a good story, gave us a full explanation of what was going on in that space. So the positions that we held were DFA Global Real Estate and the iShares Capped REIT, both of them being relatively low cost investments, but more sort of benchmark investments, more index-like investments. We used the decline in those investments for tax loss harvesting purposes. Again, if you want to go back, we interviewed Vern Vippel, our in-house legal counsel, to talk about tax loss harvesting in one of the Guide Through the Storms. But we used that as a way to, get us some space to save some taxes. And with that money, we bought a combination of Kate McDonald's fund, the Signature Canadian and Global REIT funds and ETFs. And we allocated some money to Equiton residential income. And again, the manager of that fund, we actually attended a webinar that he did today. But we had him on your Guide to the Storm if you want to learn more about what's going on with Equiton. But they buy local private apartment buildings. Signature has outperformed DFA and iShares, both in up markets and in down markets. So we're quite comfortable with that. And that was something that you, a change, Paul, that you wanted to do. What was your thinking behind making the shift from the more benchmark style investments to something a bit more strategic?
Well, I think your comment as we led into this section was, it's really COVID has driven home a very significant change in the markets. A lot of real estate investment trusts were historically focused on office buildings and retirement homes, and to some degree shopping malls. And I cite those as examples of, in a COVID environment, people are now looking at offices and saying, workers have been able to operate pretty significantly and fairly efficiently outside of an office environment. And I believe there's going to be a real rethink of whether companies maintain the amount of office space that they had before. So to me, This was a trend that had started, but COVID-19 clearly accelerated. When we look over at the retirement homes, I don't think anybody could have predicted the impact that there would be on retirement homes. And one of the key concerns right now, if you hold retirement home securities, are some of the legal liabilities that might go along with that. We know that there have already been some class action suits begun, and that's an area in light of that we want to avoid. And last but not least, I think a trend that had already started is people were using shopping malls as a great showroom and then checking out the best price and then going online and buying. And I believe that that's had a very, very fast forward. And many of the traditional shopping malls, they've already been significantly hurt in the US, and I would expect the same to follow in the Canadian market. So sorry for getting too deep into that, but it was a real aha moment that COVID really revealed.
Right. And a firm like Signature is underweighting those assets, and thus we want to be in areas of strength and avoid areas of weakness. And so we made a decision to hand over our money to an active manager. Fees are a little higher with an active manager, not crazy higher, but they are higher, but I'll show you how we offset those fees in the next little bit. So next we turn to individual equities, and individual equities are not something, Paul, that we've really used much in the past, but we made a decision through the COVID-19 storm to look a bit more at individual equities as part of the portfolio. Do you want to talk about that for a sec?
Yeah, I think it was really driven by us looking at each of the securities that we held and saying, if you hold a broad basket of securities, so let's say the TSX iShares index, you will hold a bunch of securities in there, and there's a reasonable likelihood when we looked at COVID that a number of those companies might be severely impacted by COVID. And so we thought, this is a risk we can't take. We really need to understand in each case what we hold, and we want to be looking for companies that have strong balance sheets, are strong likelihood of surviving and likely thriving by maybe being a leader in a sector that they might take over weaker players. And we needed to see strong growth in future earnings. So the idea of it was a dramatic shift as a result of dramatic circumstances that we found ourselves in early in March.
Yep, thanks, Paul. Now, part of when we look at one of the early trades that we did is that we sold gold, a gold position sort of around the, in April and May, and gold has actually been quite strong. So as we were preparing this presentation, we were preparing to apologize for that sale, but we invested that money in a combination of Royal Bank and TD Bank. And you can see here the performance that Royal Bank, since the sale of gold, we turned a 13% increase into a combination of 20 and 14. So somewhere in the 17, 18% range versus a 13. So we picked up probably an extra 5% by making that switch, even though we moved out of something that has performed very well in this. Now, we also purchased a number of individual securities, and I'm going to use one of them as an example, and that being Adobe. And you can see on the chart here that Adobe has had very, very good performance through, looking back over the last 5 or 10 years. It's had very good performance, but the orange line represents earnings. And earnings is really, this is the one thing I like to ask people, what is the core driver of performance of stock performance? And the key driver is really earnings. So you can see the correlation between, as the earnings started to strengthen in 2015 in Adobe, that their stock has really taken off and has really performed amazingly well. So, so that's something, look at this from $100 back in 2015 to $440 there. So we purchased that, well below current levels. We purchased it back in, the depths of despair for that stock. The second thing we look for is, so we're looking for, and just to go back to this one again, we're looking for companies that have consistent and predictable earnings growth over time. Then the next thing we want to look at is, do we believe that those earnings will continue to grow at similar or at a reasonable pace? And you can see by this chart that the earnings of Adobe are expected to grow by the end of 2022 from $7.58 to $12.79 per share. So if that happens, that is going to be a very, very good stock to own over the next couple of years. And then the third thing we look at is, can we buy these stocks at a reasonable price? And the orange line represents the price earnings multiple of Adobe, and you can see that, and the red line is the 5-year average of the price earnings multiple. So be a little technical with you, sorry for that. But you can see right now, that we were able to buy that below the 5-year average with a company whose earnings are just taken off. And, that's proven to be a good investment for us so far. I think we're up 30 or 35% on it since purchase in April or wherever. But don't quote me on that. We can get you the actual numbers if you want to know. So these are the three things. Can we find a company that has consistent and predictable earnings growth, where the earnings are expected to continue, and we can buy them at a reasonable price? So through that analysis, in the depths of COVID despair, we were able to purchase stocks like Adobe in the technology area, Amgen in healthcare, Amazon, which has really benefited from COVID-19 because everybody's just buying everything online, MasterCard in the financial services area, Home Depot. There's a huge building boom going on in the US, and we were able to buy that. L3 Harris, which is an industrial, that's disappointed us a little bit. It's been okay, but it really hasn't had the recovery that we're looking for. Hershey in consumer defensive, Berkshire Hathaway, Google, Cisco, that stock will perform once schools and hospitals, open up back to full speed. Medtronic, TD Royal Bank, and Canadian National Railway are the stocks that we were able to acquire at very good prices during the decline. So as I say in the next line, these were purchased at distressed prices, and most of them have recovered really strongly, but on average, their earnings are still expected to grow. If I took this whole group of companies and I took the average growth expected in earnings between today and the end of 2022, they're expected to grow 67% over those next 2 years. And right now, with the rally, they're trading slightly higher than their 5-year average, but at a level that we feel is still acceptable. But we're watching that to see if things get carried away on us. So following the sports analogy, we're really managing 4 teams, and we've structured each of them to contend for a championship over the next 12 months or longer. The fixed income private debt should continue to perform somewhere in the 6 to 7% range. We're confident in the equity managers that we've chosen, and we've opted for more defense and trying to choose, we're trying to choose the more defensive managers versus the more volatile managers. Our real estate position is, I think somehow we skipped by a slide on the investment manager side. We've chosen a couple managers. One, David Fingold, who has a track record. His performance over the last 3 years would have beaten every single position that we held in our managed area. But when you talk to David, the one thing he hates when you talk to him, he says, number one, I hate losing money. Number two, I hate losing money. Number three, I really hate losing money. So we've opted for a manager like that. We've also added another manager, Monroe, who actually is they're an Australian manager who invests globally, and their performance has been tremendous. I think they're up 25% year to date, but they also buy protection. They buy insurance on their portfolio. So, without getting too detailed, they buy puts that where you benefit if stocks drop, if they feel that they're getting a bit uncomfortable. But they also try to really focus in on the areas of strength, and they really try to avoid the areas of weakness. We believe that our real estate position is more stable than it was before. The yields on it are very high in the 5+ range, and we think that there's good upside. Our individual equity picks have demonstrated consistent and predictable earnings growth that's expected to continue and are trading at reasonable prices. And even there, we're being somewhat defensive by holding cash to reduce risk and to acquire bargains if there's another sell-off. Now, I see another question there, actually. Let me just pull that up there. Question, again, go to that Q&A button if you have a question. We love your questions. We're happy to answer them. Question, I noticed that your portfolio doesn't appear to have many holdings in the energy space. So Paul, prices dropped pretty significantly. Do you think that it's a good time to own energy stocks right now? Paul, unmute.
Yeah, it's a great question. And I can tell you that because we're looking for greater certainty, and there is, the world is awash with oil. And let's face it, countries are now desperate to get some of their oil sold. And so we've seen major scraps fighting for volume, probably to get the foreign currency that they need to operate in their country. But it's too nebulous. There's very little control over the pricing. Now, I will tell you that we did a couple of opportunity trades very early on when oil and gas made it, oil was at a 23-year low, and we were in that market very selectively for about a month because it was just so low and it was really bouncing off the bottom. But on an ongoing basis, until we get back to more normal times, we just think that the vagaries of the commodities market is just not worthwhile.
Yep, and just throw my comment in, and please understand that Paul is the portfolio manager. I work with Paul, and I'm simply a host to these webinars, but also do a lot of quantitative research. But energy stocks and metal stocks go up and down, but sideways over time. So for a longer term investor, it's not a great investment. For a trader, it's a tremendous opportunity because you've got the volatility that they look for. We're not trying to trade. We're trying to find great companies. We're trying to hook on, to use the sports analogy, we're looking for a Sidney Crosby, Wayne Gretzky, Mario Lemieux that can be on our team for 20 years. And, if we can find a stock that returned 30% a year for 20 years, we probably would never sell it. So, and maybe even higher than probable. So we're looking for those consistent and predictable earnings growth companies at reasonable prices, but we're also holding some cash to, for bargains that come along. So in conclusion, although past performance is not a true predictor of the future, and the future is impossible to predict, as advisors, sometimes we take heat. Then how come you didn't see COVID coming? How come you just didn't sell everything back in March? Number one, that's not the way you manage portfolios. But number two, our crystal ball was in the shop for repairs that week. I think, Paul, wasn't it?
Never owned one, actually.
one, right? So, but we think that we've assembled a strong team that's going to play hard. It's going to play very disciplined. That's that's one guarantee, is that we'll play hard and we'll play disciplined for you to help you to achieve your goals. So that is, now we're on to the question and answer period. If anybody, again, if you go on your control panel to Q&A and you have a question, please type that in. I see we have another one that just popped in, which says, I understand that you, as the portfolio manager, in parts of my portfolio, that it's up to your discretion. It says, I think they're saying, Paul, that you're a discretionary manager. Is it important for us as investors to keep track of what you're doing regards to this? In other words, is it really worth, should we be tuning in and listening to what you're telling us about, or should we just turn it over to you and let you make all the decisions, as that's what we hired you for? I think that's what they're asking. Paul?
Well, I mean, obviously this is it's a matter of opinion. I would much rather have educated clients. But the reality is, as a discretionary manager, we take responsibility for the outcome and sort of the volatility along the way. So I think people are better not looking at every single detail, allowing us to use our discretion. And we're watching these markets constantly and holding us accountable to the outcome. Having said that, because we've made some fairly significant changes since COVID began, we're doing these sessions because we want people to understand not only what we're doing, but why we're doing it. And I think as time goes along and people getting a comfort level, I know a number of people have said, okay, now I get the rationale. I'm sort of dialing it back. I'm not keeping track of every single change because I understand the rationale. And so it's really a matter of personal choice, but I would say it's not something you have to watch the markets all the time. That's what you hired us for. That's what you're paying us for. And we're happy to take on that responsibility.
Right. Paul, another question that popped up is, so you really haven't talked about, the portfolio performance, and, how have the portfolios performed? And during the storm videos, we constantly showed you the performance. I just got some up-to-date numbers. The moderate conservative portfolio is just a couple percent underwater for the year, which I think under the circumstances is fairly good and is better than either the TSX or the S&P. Balanced portfolio, again, beat both the TSX and the S&P, or the SP is actually up 4%, so we're a little bit behind that. And moderate growth in the -3%. If you want to get an update on your portfolio performance, talk to your advisor. And they will be pleased to pull that report up and show you how you've done overall. We have another question here, that at what frequency will you upgrade the grades that you've given to yourselves? And how will you evaluate the new players? How long do they have to prove themselves? And Paul, I can do that, or you turn it over to you.
No, go ahead, Bob, and I probably will have a view on this, but go ahead.
Yeah, so the answer to that is, it's funny, I find when I listen to webinars, everybody says, that's a great question. And so I try to not, even though I think that's a great question, I'm not going to say that it is. We review the portfolios on a regular basis. I heard an interesting comment from a portfolio manager recently where he said, many investors have a 10-year time horizon on their investments, but they check it every week for performance. So they really focus in on the short term, and the short term is hard to predict. We review the portfolios and the holdings on a regular basis. Every week or 2 weeks, we look at every single holding that we have. just to see if there's anything that's going on. Companies from a fundamental standpoint, they release performance on a quarterly basis. So we're watching for that, what the quarterly performance has been, what their earnings have been for that period. We're watching that. We tend to give, especially with third-party managers, we tend to give them more scope, more rope, not scope, and to do that. How often will we grade ourselves on this? Every 6 months, we'll grade ourselves on how we're doing. Maybe we grade ourselves probably every day, but formally every quarter, every 6 months, we'll do this. And if that's something that if you want to just type us back, tell us how often you think we should be grading ourselves on this. Generally, I look at a 1 year time horizon. Once a year, you should look at it at the end of the season, at the end of the hockey season. You should look at your overall performance and make a decision as how you're going to do. How long do companies have to prove themselves? Managers have more rope. Individual equities, again, we look at them once a quarter. But we also have some technical factors that we use that I didn't even talk about, that if we see that there's some price deterioration, we'll jump on that and we'll do a review. So if we see the stock drops 10%, that's an immediate review for us. Are we missing something? What's going on there?
So let me just give you Bob, I'm glad you sort of finished it up to say a 1 year time period. And what struck me is, I look in the mirror every day before I leave for the office or even my home office. And I look and say, well, this isn't quite right. I'm going to do something a little bit differently. But I find that from an outside perspective, you're really measuring outcomes, not just the inputs. So we look regularly, virtually weekly, at the inputs to see how individual securities are doing, are there announcements, and so on. But I think it's realistically to really be assessing that on an annual basis. Now, these are unusual times. And for example, if J&J that made an announcement that they're in final trials for a solution to COVID-19 came out, that might allow us to make take a different tack in a certain sector. Conversely, and we're still in the area of lots of second waves that are happening around the world, this is really why we're continuing to take the defensive tack. I'm sitting in the boardroom and I'm looking across at a very large whiteboard that has one security that we've been watching because it remains trading at about a 40% discount, and it's in the lending business. And there is something that there was about a month ago, there was a buyer that came in and was looking to buy that stock at a premium. And so we're watching this one very carefully because there are outside influences that are going to happen. But those are inputs. To me, the assessment time is more like a 1 year period of time.
Yeah, but we're really trying to build a team of Sidney Crosby's, Mario Lemieux's, Wayne Gretzky's. And if we get those players, we want to hold on to them as long as we can. Newer ones that come in, they're on a shorter leash. We're watching them much more closely. Another quick question that came on, and somebody's just having some fun here. He said, I like the sports analogy of running your portfolios like a hockey team. Do you think that you can help the Leafs? Anyway, but we've kept everybody here for quite a while, and we appreciate this. I think, we will run this type of webinar on a regular basis, on a quarterly basis. We'll update you on what's going on in the portfolio, to go back to the other question that was there. We'll update you on a quarterly. We'll judge ourselves on a quarterly basis as to how we think we're doing and how the changes that we've made are performing better. But thanks everyone for coming out. Enjoy the lovely summer weather. It's mid-August already and summer's almost over. And where is it gone? So enjoy that, and we'll keep trying to improve our team and get them to play hard. Thanks for coming out. Enjoy the weekend.
Bye for now.